All right, folks, welcome back to another Rev Real Estate Live. My name is Dallin Schultz. I am the host and president of Rev Equity Group. We focus on passive investments within the multifamily space. We started these weekly webinars just probably about a month ago because we realized there's not enough education, not enough content out there to help people understand the benefits of multifamily investing. So we cover a bunch of different major aspects on these webinars. We'll bring in guest speakers to expand on tax benefits, on different strategies. And the whole purpose of this is just to let people know that there's a better option, that there's a better way out there to invest. And we personally at Rev feel through our due diligence, through our research, that multifamily has and is the most recession resilient asset class. So it's something we're very passionate about. We're very passionate about educating and spreading the word about it to others. And we do it through these webinars as well as monthly meetups. So a couple of years ago, we started a meetup here in Phoenix, the Rev Multifamily Meetup. And within about a year and a half, we became the largest one in the entire state of Arizona. And we were getting about 80 to 100 people a month out to that event. And it was really exciting. It was really fun to experience that growth. And we decided to take what we did to grow that event here and start setting up chapters in different markets. So we're currently in 5 different markets and looking to add 3 to 4 additional markets a month moving forward. And that's just to create a nationwide network of people getting plugged into the multifamily space. So that's a little background about us. But I know you're all not on this webinar to listen to me. You're all here because of our guest speaker, Trevor Thompson, who I'm really excited to have on. Trevor is a very experienced passive investor, and not just multifamily, but various asset classes as well. So he's had the opportunity to connect with different operators in different markets. And I'm really excited to have him on the call with us today to share his experiences as a passive investor and really what he looks for when vetting an operator. Because at Rev, what we focus on, there's 3 main, I guess, the process of vetting that we go through. Number 1, we vet the operator. Before we even get in, look at the deal, we vet the operator. Then we vet the market. And then we vet the deal thirdly. And the reason being is because you can have a really good deal with a bad operations team, and they can run that deal into the ground. On the flip side, you can have a bad deal or a rough deal with the right management team, the right operations team, and they can do very, very well with it. So our process of vetting, again, is starting with the operator. And we touched on this on one of our webinars briefly a few weeks ago, but we're diving deeper into this aspect of the vetting process. So without further ado, I'm sorry, before I turn it over to Trevor, typically how these are ran, that if you have questions throughout it, if you wouldn't mind just typing the questions into the chat box, that way we can address them and I can share them with Trevor as those questions come up. But I'd like you to put them there so you don't forget about them. And it's often when you have a question, other people might have that as well. So without further ado, I'd like to go ahead and introduce Trevor. Trevor, thanks for being with us today.
No, it's my pleasure to be here. Thank you. So do you want me just to hop right in, or?
Yeah. Sorry, I could have.
So sharing screen is disabled. I don't have to share it. I can just talk, but depends.
I can. Give me 1 second. Paul, walk me through this again.
Yeah, you just go to the more on your phone.
Security.
Yep.
Share screen. Okay, Trevor, give that a shot.
Excellent. It is working. So what I'm going to do is I'm going to take you and I'm going to do an abbreviated version of my presentation. So if you can just tell me that you can see it here.
Yes.
Awesome. Okay. So I'm going to talk a little bit about the power of passive investing. I'm going to do this fairly quickly because I'm not sure the experience level of everybody. So we'll go quickly through some of the slides, what is syndication in that. So a little bit about me. I'm a passive investor that's turned into an active real estate investor. I've had 47 years within the attractions and entertainment industry. The last 20 plus years was with iFly Indoor Skydiving, and we grew that company from 1 to 80 locations worldwide. And I actually opened 46 of those. And I'm now turning my skills over to passive or to commercial real estate investing. So what is passive income? It's quite simply where you convert your time into cash, then you take that cash and you convert it into real assets that will produce passive income without your time. This is the disclaimer. I'm not selling anything here. Everything I think that I'm presenting, I believe is honest and true, but there are no guarantees. And before you invest, you should consult a professional advisor. So a little bit about real estate syndication. It's an investment mechanism that puts real estate income within the reach of the average person. When you invest in a sponsoring's offering, they pool your funds with other investors. They combine it with bank loans to buy real estate property. As a limited partner, you enjoy limited responsibilities. The general partner, the sponsor, they do all the work while you receive your share of any of the profits. So this is a little bit about my journey. I'm not going to go through it here because there's a little more detail. So as Coda mentioned, Dallin mentioned, I've got quite a few real estate different investments. So I started in 2018. My first investment was 58 doors in Houston, Texas. Then my second investment was 176 doors in San Antonio. And I actually very uniquely, as a limited partner, I volunteered to be asset manager. This was a struggling property. That's a whole other story for another call. At the end of the day, these two first passive investments actually went full cycle and I made no money. And it also, so it really solidified the who should I invest with, and we'll talk a little bit about that later. And then here's a whole of different ones. So this one was an apartment to condo. This is a retail center up in Plano. I'm still a member of that. This was a land development. I've come out of the first cycle and I did not stay for the second cycle. So what I mean on that one was I just invested in the entitlements, getting the land ready for development, but I did not stay in the investment for development. I'm in a 200 and actually that should be a 25 single family home portfolio fund. My first investment outside of Texas, I should have started, I'm in Austin, Texas, was 276 doors in Tucson, Arizona. This one has gone full cycle and I refer to it as my first home run. They actually 3x'd my money in 20 months, so I'm quite happy, and reinvested in another one of their projects. This is another one in Houston. It's actually going full cycle this week. So I'll get about an 18% ARR on this particular deal. Then one of the things I did here, if you'll notice, all of these apartments are what I'm going to call value add. So I decided to switch. So this one is up in Denton, Texas, and it was an A+ property. It was bought by a syndicator from a developer. So the developer built it, got it about 80% leased up. And so it was a different business model where they were basically burning off concessions, leasing it up, and then doing all the different value adds. And then we go through here. These are all apartment complexes that I've invested. This is one land development here in just behind the Tesla factory. And then I switched out my Arizona investment to Stella Commons with the same investor. And then I have switched to a GP. So I'm a small part of a deal, Wesley Place in Columbia, South Carolina, and closing the second week of November, 75 doors in San Antonio. So one of the things I want to talk, we all know on this call, right? Why real estate, 90% of all millionaires became through real estate. Obviously there's a lot of tax breaks and deductions. We're not going to go into this too much, but real estate is one of the most tax favorable passive investments that you can make. There's appreciation. So real estate tends to increase over time. And then there's forced appreciation where a good operator makes improvement to the property. This combined with improved management creates forced appreciation. And then of course, we're all aware, if you've been investing for a while, in accelerated depreciation. It's something that's in the tax loop law that allows you to take your acceleration even quicker. So what is real estate syndication? It's a partnership between a sponsor, often called the GP, and a group of investors, often called LPs. Together, they purchase a property that they otherwise couldn't afford. So GPs and LP responsibilities. The GP is responsible for all aspects of the deal. They negotiate the purchase price, they arrange the financing, they create and execute the business plan. Passive investors, they provide working capital. This combined with bank debt, purchase of property. Passive investors are exactly that. They have no responsibilities other than picking a deal. Then the profits get split. So in exchange for their efforts and initial at risk and efforts to do the business plan, GPs receive a share of the profits. LPs have no responsibility and sit back and collect shares, often their share, often called mailbox money. The splits for deals are very, very different. Depends on the deal. And it can be anywhere from 10 to 50% of the proceeds, a part of the partnership going to the general partner. It really just depends. And then sometimes they also offer things like a preferred return or a waterfall. I personally like a preferred return. I like to get paid first. That's a very important part of me. So offering memorandum. I'm sure all of you on this call have read one. If you're having trouble sleeping at night, it's a good document to read, but it basically outlines all of the things that could go wrong. But it's very important, and it's very important for you to look at some of the key points in the offering memorandum. You want to understand, what can the GP team view? What happens if there's a cash call? What happens if there needs to be different things? How can you vote them out if for some reason you need to vote them out? Are they returning? Is it return of capital or return on capital? These are all some very important things that you need to be sure that you read and understand in your offering memorandum. So there's different types of classifications of investors. There's an accredited investor, and an accredited investor meets the income of 200,000 as a single or 300 combined. They have a net worth of $1 million, not including their primary resident, and they can invest in a 506B and a 506C. Then there's a sophisticated investor. They do not meet the accredited requirements, but they have sufficient knowledge and training and advanced types of investments. They can only invest in a 506B. However, there are limitations of a 506B. There is no general solicitation allowed. Investors has to have a substantive relationship with a sponsor. So this one is a little bit of a gray area. What does substantive mean? And what I believe it means, and from what I've studied, what it means is that we've connected one-on-one. I have an idea of what you're looking for in investment. I have an idea of what is your net worth and what do you understand about investing. And then I make sure that I'm providing an investment that matches what you're looking for. So if we go back on some of the investments I've made, some people need cash flow. So you're going to want to invest in more of a stable asset, one that is producing cash flow during a period of time. We talked about that I have a couple of land deal investments and a new build investments. Those ones aren't going to produce any cash flow. They're really generational wealth creation, to where once the deal is done and it's sold or it's done different things, then you receive your portion of the profits. So how do you become a sophisticated investor? Broadly speaking, is one who might have a high net worth or a high income. You gain them by attending meetups like today, joining other meetups and training sessions, spending time on YouTube, watching real estate sessions, and attend any in-person meetups in your area. So you want to make sure that you get enough education. So who should you invest with? And very much what Dallin said earlier, I think very similar. And I do it this way. I call it, first of all, it's a very personal decision, but I say the jockey, the horse, then the track. So what do I mean by this? So the jockey is the general partner who brought you the syndication. Do you know, like, and trust them? You're going to be partners for a long time. Research their track record. Do they give you opportunities to learn? Do they give you opportunities for future relationships? So for example, the deal I told you about that I did really well in Arizona, I actually spent about a year watching these investors. I went to several of their webinars. I looked at several of their deals. I went to some of their training sessions. I actually took their asset management training session, and it was very beneficial. So I got to know them. Then I made the investment in them. Then secondly, the horse is the asset. So what type of are you going to invest in? And there's obviously multifamily, which a lot of us here do. There's storage, assisted living, retail, hospitality, development. Then you need to know, what is the quality of the asset? Is the asset stable, value add, deep value add, new build. They all have unique differences. And then the track is the type of asset. The track is the location. Again, the options are limitless. What country, what state, what city, what neighborhood, the list is endless. So for example, I like to invite in what I call pro-business states. So pro-business states are Texas, Arizona, the Carolinas, Florida. There are definitely more, but I like to invest in pro-business states. Then I like to invest in areas within those that I think are seeing rapid growth. So again, I know Texas very well. So if you look at Texas, there's Dallas, there's Austin, there's San Antonio, there's Houston. There's a lot of things that are growing within those markets, but within those markets, there's definitely some differences and things that have to happen. So that's it. Hopefully that was somewhat interesting. I don't see any questions. So either I did a great job or I lost everybody.
Oh, you did a great job, Trevor. No,
I tried to do it fairly quickly.
That was excellent. Appreciate that. One thing that I feel isn't stressed enough, and one thing that we mentioned a lot of times with our investors is that when we're partnering on a deal, that's exactly how we view it. We view it as a partnership. Now, whether you're in a partner role or a general partner role, it's still very much a partnership. And if it's not mutually beneficial, then you shouldn't be doing it, period. And that's just my feelings on it. So Trevor, you touched on briefly one of these, I think it was your Arizona asset that you studied, you watched the team for about a year, and you definitely felt like there was some synergy there. Can you dive in a little bit more to what exactly that was, what it looked like? What was it that made you decide, hey, this is a good team. I want to put my capital with them and work with them.
Yeah, definitely. So the one thing that I found very interesting was on their education. See, everybody that wants to come out and do anything, we all want to look good, right? Everybody wants to look good. But what I was really interested in is they actually talked about their challenges. They talked about a particular property that they had and how hard it was to make adjustments on the property and how they executed their plan and ultimately ended up being successful. So what I liked about them was what I want to refer to as general honesty. They weren't there saying, hey, listen, we know everything. We know this, we know that. They were very honest about what they knew and very honest about what challenges they had faced. And where other people, they're only telling you the good things, right? They're not telling you the challenges. And anybody who's involved in any sort of investing, you really know that there's challenges. It's a business. And no matter what happens, there's going to be challenges for you to have to overcome. And so I liken to invest with people that are honest and open about their challenges.
Well said. I couldn't have said that any better. Now, speaking of challenges, I want to, if you're open to it, dive into these first two deals that you mentioned early on. You said that these were your first two deals. You got all your money out of them, but you didn't make anything on them. So let's dive into that a little bit.
Yeah, so both of them I was very early on, so I clearly wasn't as educated as I thought I was. Just like a few people, I went to a few webinars, did some seminars, did some things and thought, oh, I really understand the market. So there were three things that went inherently wrong with these deals. First of all, the state of Texas is very aggressive on property tax collection, and they did not estimate their property tax collection correctly. They basically just showed about a 10% increase when they were buying a property at a much bigger increase. So what had happened was their property taxes had gone up. The second thing they did was similar with insurance. Insurance has gone up quite a bit US wide, but definitely places like Texas with Katrina, and they call it Snowgeddon. Our insurance rates have gone up a lot. So they did not pre-plan for their insurance rates. And then the third thing that I didn't understand was they said, hey, our rents are here. We're going to push our rents to there. And the one property that I helped asset manage, it really became apparent to me that when you're looking at rents, so you normally want to have people earn 3 times what your rent is, right? So if you're looking to get $1,000 a month, you want that person to own $3,000 a month. And you often, what had happened there is these people they wanted to get rents up. I'm just going to use 1,000 to keep it simple. But the people in the area were making about $2,500, $2,000. And you could not push the rents into the area and get it up to where it needed to be. So you add those three things together, that their property taxes were underestimated and they appealed, but they still didn't get them. Their insurance went up, they appealed, but they still cost more. And they overestimated the rent bumps that they could get. And this is a very big thing. You got to make sure that the rents within the area can be achieved through that particular property.
You brought up excellent points right there. When you're looking at the operational expenses of a property, often your two biggest expenses are your property taxes and your insurance, especially in areas like Houston, Florida, places that can be affected by natural disasters, maybe more so than others. Now, where I live in Arizona, insurance and taxes are extremely low. And so not all real estate is created equal. Not all markets are created equal. So for example, property taxes in Texas, they'll be reassessed every single year.
Yeah.
Right. And in Arizona, a law was passed a few years back that your property tax, your limited property value, which goes into the calculation of your property tax, will not increase more than 5% a year, even on the sale of the asset. And so what that works out to be, what that translates to be, is about a 3% increase on your property taxes. So in Arizona properties, it's very easy to project what that will be, because you can look at the history and you can project what it's going to be year over year. So being familiar with your market and how they calculate property taxes, what's the average insurance in that area, are critical aspects to it. And then rent growth. I'm so glad you brought that up, Trevor, because that's something we actually touched on last week. As we're vetting a deal, one of the main things we look for is how aggressive are they on their rent increases. And the properties that we've invested in so far are typically $200 to $400 below their comps as is right now. So that's not even that's pre-renovation. So that's just one of those things that we look for as well as a team when we're getting ready to invest, is how much wiggle room is there? If things don't go as planned, how conservative can we be with these numbers? So I think those are excellent points, and I appreciate you sharing that.
And it's pretty easy to find the income in an area to get an idea if it's achievable, right? You want to make sure that it's at least 3 times income to whatever rent that they're trying to get to. And there's another interesting phenomenon that I saw. We obviously all just enjoyed massive rent increases, right? But I would notice they would say, oh, we're going to get 8, 10, 12% rent bumps just because but they weren't putting their costs up. And everybody knows that costs have gone up, right? So they were still doing the 2% cost increases, but doing the 8 to 10% rent increases, and those two numbers just don't jive, right? With rent increases, it comes inflation, comes higher costs of doing business, and so you need to make sure that the deals that you're looking at have that balance within the deal.
I appreciate you sharing that. So, question: what do you know now that you wish you knew then? What are some of those nuggets that you could share?
Yeah, so I think the most important thing that I know now is to spend the time, like I did on that one investment where I watched them for a period of time. So I get sent tons of deals. I look at a lot of deals. I'm obviously a fairly active investor. And I start looking, to be honest, I look at the deal and I look at who's sending me the deal. 90% of the deals get sent to me, just get a delete button because I don't know the team, right? I haven't had time to, and then once I start watching the team, I start going to their webinars, I start going to their meetups, I start learning more about them. I start finding people that have invested with them. And then all of a sudden it starts this synergy. Is like, okay, I'm interested in these people now. I've got to see them on their track record. I like what they do. I like how they treat their investors. I mean, I'll give you an interesting story. One of my investments, it finished its first full year. And at our webinar, they had a presentation of what income was during the first year. And I asked the question, how did that compare to performa that was in the PPM? You know, how did we do compared to plan? And their answer was, you can look up the performa in the PPM. Clearly, those people will never get another investment from me, because they didn't even take the time to say, listen, we projected this. This is where we did good. This is where we were a little. And at the end of the day, we all need to realize that everything doesn't go as projected, right? These are businesses. These are fluid. These are things that happen. But it's, again, I want to look for an investor that's honest and fair and talks about their challenges.
Now, in that scenario and situation you just expressed, Trevor, it's unfortunate that first of all, that you experienced that, because what a lot of operators, I think, fail to realize, they get so focused on acquiring the deal and managing the deal that once they get their investors on board, their investors kind of take a back seat so they can focus on the deal and on that current deal, as well as future acquisitions. And that, in my mind, that is so backwards, because your investor, you couldn't have done that deal without your investment, right? Yeah. And so you sitting on that end, I mean, I'm assuming that was probably around a $50,000, $100,000 minimum investment.
$50,000 investment, yeah.
And when they don't even take the courtesy or the time to adequately address your question, there's no quicker way to burn a bridge with an investor.
And a good way to get some of that knowledge in advance to say, could you please send me your quarterly reports or your monthly reports for your last 2 deals, to get an idea of the level of detail they're putting in their reports, right? You know, because that's very important, right? When I look at it, is there enough detail that I can feel comfortable that I no longer need, you know, there's a lot of reports that said, hey, listen, this is where we'd hoped to have been. We're a little slow on getting this CapEx done, which has made us a little slow on some rent bumps, or we've made some decisions to not renovate units and accept rent bumps. And here's the math and the reason why we've decided to do that. Because we decided, hey, why should we renovate this unit to get $200 when not renovating it, we're getting $100? And they actually displaying that area. Someone did ask where you find the income. You can do it on city data, city search. There's a couple of places that you can find the area income, and you'll be shocked that it dramatically changes. So you want to look no more than 3 miles away from the property. People do not move great distances unless they're moving to a new city. So you want to make sure. And there's one investment I'm invested in that you know, it literally was 30% more 2 miles later. But again, the people that are making 30% more aren't coming into that neighborhood because it is the wrong side of the tracks. Yeah, so looking for somebody who hasn't brought a deal full cycle, you're going to want to look at who have they partnered with. All right. So again, I've never brought a deal full cycle. I'm a new investor. And I convinced my investors to bring my money along, but I partnered with some people that had experience. So I partnered with some people one of my partners was a property manager, and she's going to be a property manager of that. One of the other partners has about 700 doors, and he's had one deal go full cycle. So you want to make sure that even if the person that you know, they have partners that have some experience. There's nothing wrong. Everybody starts somewhere, right? And I actually believe, and maybe I'm a little bit jaded because it's me, I actually believe that new people work harder, right? I am going to work really hard because I know if my first few deals aren't home runs, I'm not going to have deal 2, 3, and 4. That I need to produce good returns for my investors. So you can be nervous on a new person, definitely, but you know, you want to make sure that at least they have good partners.
What are your thoughts on skin in the game regarding operators?
Absolutely, good point. Everybody should have skin in the game. On average, I look for them to have at least 10% of the total loan amount in the game. So if a $5 million loan, that the partner should have about $500,000 in the game. And that can be after their acquisition fees. I'm okay. But I still like to see people that that have put more money in than they got out.
It just shows they're just as committed and not just trying to milk you as the investor for your capital as well.
And there are a lot of big deal makers that do that. I don't want to mention names, but if you start watching some of the big guys that are doing tons of deals, you know, they're collecting massive acquisition fees, massive asset management fees, and at the end of the day, you know, they're taking $1 million out of a deal before, just as it closes. I like them to be incentivized, and we talked a little bit briefly about preferred payments. I also like preferred payments. And what a preferred payment does is it says that the investors are going to get paid this particular amount of money before the general partners can take any money out of the deal. So I always like a deal that has a pref payment where investors get paid first, because I want the partners to be motivated to make more returns than the pref payment so that they can start collecting their returns.
Excellent, Trevor. I like hearing about pain points. I like hearing about challenges. I like hearing pain points. What is the most painful experience that you've had as a passive investor?
So I have one deal that, I'll be honest, I have, and it's the single family home fund, and it got in some serious trouble, right? The concept of it was they were going to buy homes in Texas. It was going to be an ARV, anybody in the single family business, appraised value of about 200,000. Well, those homes all disappeared during COVID and when prices went way up. And I sent the sponsor a request saying, I sent him an email saying, I've had no updates from you. This is super frustrating. Have I lost my money? Do I still have my money? Am I going to make money? And the answer was, you're going to make money. Would you like to be bought out? And I said, absolutely, please respond with the offer. And they never responded. I mean, horrible, horrible. I will never invest with them again. They're in a small group, so they wouldn't connect with very many people, but never invest with them again. I have no idea if I'm making money or losing money.
One thing that's been a reoccurring theme, Trevor, as you've shared about good and bad experiences, it keeps revolving around communication.
Yes.
That kind of seems like the common theme that I'm picking up from your experiences. So as an experienced passive investor, what are some of the best ways operators have communicated with you? Maybe specifics that they did, or what would you like to see in future operators based on your experience?
Yeah, so I like at the beginning at least a monthly report. I understand that eventually it could go to a quarterly report. I actually invested in a project and they gave a weekly report. To be honest, I thought it was a bit much. It was a very basic weekly report, but I really appreciated it. And I got a really high level of trust with that operator. And there wasn't a lot of details in it, but it was, you know, it was the new build that they bought, right? So there were still a lot of things happening, right? Because they were only 80% occupied, you know, and so they would give little reports on, we had this many people come into the leasing office, we got these rents, here's where we were burning off a lot of our concessions and things that were happening. It was very useful, but I want to know basically the main metrics, right? What is the occupancy, both in terms of bodies indoors and especially, you know, what is the economic occupancy? And the big difference is who's actually paying the rent. How many people, if we're suffering on occupancy, how many people are coming in and how many are you approving, right? I'm okay if they only approve 1 out of 10, because I'd rather have a quality tenant that's going to pay the rent, but I'd like to know those information. And then I'd like to get the information basically on high level expenses, I'm going to call it that. There is one deal that you actually click through and go straight to their P&L. Their P&L is uploaded on the portal. That could be a little bit dangerous. It's a little bit too much information, a little overwhelming for the average initial investor, and they may be setting themselves up for a lot of like what I'm going to call Monday morning quarterback or small questions. You know, so I'm quite happy to say, okay, here's the top line. Here's where we're going on this. This is where we're on our CapEx budget. You know, here's our plan. Here was rent projections. Here's where we're at and why. I like the why, right? Why are we there? Why did we surpass? Why are we not quite got there? Those things are all very interesting to me.
I attended a conference about a year ago, and they were talking about relationships with investors. And this was a real estate guy's secrets to successful syndication. Very awesome conference. If anyone is looking to get interested or getting more involved in the space, I'm not an affiliate for them. I've just been to it, and they have excellent content and speakers. But I think it was Russell Gray was talking and said, bad news builds trust.
Yes.
Like most investors, when you get into a deal, there's always risk. Risk is unavoidable. It's risky to not invest. It's risky to invest, right? Everybody's risk tolerance is different, but for the most part, people understand that not everything is sunshines and rainbows. Nothing goes perfect every single time. And as an operator and as a passive investor, that having that open line of communication we've identified is key. And if there's bad things going on, let them know. But don't just say, hey, crap hit the fan. We'll give you an update in 2 months. No, say, hey, this is what's going on. This is what we've done to address it. And this is where we're taking it.
Yeah.
So it's a multi-step process.
Absolutely. And there was a quick question here in the chat. Based on what I know now, would I have started as a GP or still started as an LP? I still would always recommend starting as an LP. You know, I think that you should invest as a limited partner. I think you should gain some education. You should see what's happening. You know, a lot of these mentor programs or groups, they try to push you to GP too quickly. And there's no real reason. Now, I switched to a GP because I lost my job at COVID and I decided that I needed to start earning some money. So I switched because I needed some active source income. It's a little bit different. When I'm a passive investor, I didn't want to live off my passive income because I wanted to continue to invest it so that I could, you know, definitely grow my wealth, right? If you start living off your passive income, now you're only reinvesting your capital again. So I did it that way. And also people on the GP side need to know it's real hard work and it's real risk. So for example, my first GP deal, it was a big one. It was $240 in San Antonio, $25 million deal. And we could not get the deal closed. And as a group, we lost $350,000, which 75 was mine. So I want to clarify, no passive investors that put their money in lost any money, but the general partners, we took that risk and then we decided, you know, and then the deal couldn't happen. It was a loan assumption with a third party pref equity and investor capital. We could never get the third party pref equity approved by the lender. Very frustrating. And you know, so here I am thinking, okay, I'm going to start earning money. I'm going to go to the active side, and the opposite happened. You know, I lost some investment. And I think Taisha had a question.
No, I didn't. I was just agreeing with you and clapping for the fact that you said people push investors to the GP side before they have a chance to understand the deal. You cannot add value as a GP if you haven't been a limited partner yet.
Yeah, and lately, because it's been a struggle to raise money right now, everybody who's kind of involved in this knows right now is a tricky time, right? A lot of people are afraid, just afraid of money, not afraid of real estate, just afraid of what to do, make a mistake. And it's a hard time. And so I've had it where some people have brought some people onto their team to raise money. And these people don't know anything about the deal. They really don't know anything about the deal. And they don't have the experience to answer the questions. And clearly I'm a very experienced passive investor. So I got a lot of questions, but I'll be honest, right then and there, the entire team got wrote off by me. I found out who were the main sponsors, who brought these inexperienced people into their deal. And that whole team is X'd off of my list because I don't want to get involved in a deal like that. And Dominic asked for somebody who's new. Somebody who's new, keep joining in meetups like this. There's a lot of other meetups. Follow me on LinkedIn, Trevor Thompson. I do an in-person meetup or virtual meetup the third Thursday, but get connected with meetups, get connected with people in your group. While I don't always believe with all the mentor programs teach, I still believe it's a very good idea to become part of a mentoring program and to get some coaching from people. It's a very good idea. And then just start reading books. Again, on my YouTube channel. I don't here to promote myself, but I just recommend books that I've read that have touched me. I've kind of ran out of real estate, so now I'm talking about some non-real estate books and trying to tie them back in. But it's very important that you find what I'm going to call credible sources of people willing to answer your questions and talk to you.
Your network truly is your net worth. And we've attended a lot of these large conferences and mentorship programs. It takes a year to really get to know someone. You connect with them at a conference, you see them on social media, you start seeing pictures of their family and other things that you're doing. That takes time.
Yeah.
So there's different ways to go about it. I know some people that have invested into these mentorship programs straight into the GP and have done very, very well. But I feel like the operators that are doing exceptionally well are the ones that started in an LP position. They realized and learned what they liked and what they didn't like, and they were able to experience that side of investing so that when they now become a general partner, they know how to have that open line of communication. And Dominic, to your question, there are so many free resources out there. If you're newer to the space and looking to get started, don't go to one of these mentorships and buy their $30,000, $40,000 program. If you're getting started, go to it, listen to it. There's still a lot of great content, a lot of great information, a lot of great people to connect with. And since they're trying to sell you on a $30,000, $40,000 mentorship, you can usually get into a 2 or 3 day conference for like $200 or $300. Like that to me is a no brainer. And that's why I still go to them, because it's a great place to really connect. And then what happens is that you start going to other conferences and you start seeing the same people. Now, when you start seeing the same person over and over at different conferences, that builds trust, because you know that they're as committed as you are as well.
And there was one other big point that I missed, and I'm sorry I missed it. I just thought of it. You also want to invest with people that know the market they're in, that have boots on the ground. You do not want to invest with somebody who, oh, we're doing a deal in Atlanta. Nobody in the team lives in Atlanta. They've never bought a property in Atlanta. You just don't want to do that. You want to invest with people in a market that they know, in a market that they're familiar with, and they have what I'm going to call boots in the ground. Somebody who's in that market that can visit that asset on a regular basis. It's not inconvenient. And then one other thing too, on the sponsorship team, some people still have full-time W-2 jobs. I understand that happens, but you want somebody, particularly who is the asset manager, who's responsible for the day-to-day of property. You want those people to be a full-time person dedicated to real estate. You don't want them to have to try to get an hour off of their W-2 job to take an emergency phone call. You want people that are full-time dedicated to real estate investing. That's who you want to give your money to.
Awesome stuff, Trevor. Excellent information. Well, we've got a few minutes left. Let's just open it up now for Q&A. I appreciate you all putting those questions into the chat box as we went about. But any questions here for Trevor before we close out this hour?
And I did put my contact in the chat there. And again, thanks for having me. Somebody followed me on LinkedIn. Thank you. Education is huge. That was when Dallin reached out to me earlier this week. I'm like, yes, the answer's, he said, really? I'm like, yeah, the answer is always yes. If somebody wants to talk about learning about real estate investing, this is what you want to do. You want to learn it through people like this and in this casual environment, right? Nobody's selling you anything here. Nobody's, they're not trying to do a mentorship program. They're just trying to provide education. And that's huge.
I got to share this real quick, Trevor. So a lot of you probably aren't aware, you probably don't know this. And I didn't know it. When I reached out to Trevor 2 days ago, I sent him a message on Facebook. And then I was looking through his profile and saw that he was just in the hospital for a hip. That day he was in the hospital for a hip surgery. And here he is texting me, setting up this call for this Thursday. absolutely incredible. Trevor's a freaking rock star, and I'm so appreciative that he was able to get on this call with us. And what a wealth of information, Trevor. Greatly appreciate it. Appreciate your time. Folks, if there's no other questions, I greatly appreciate you coming out. We host these webinars, like I said, every single week, Thursday, 10 to 11 Mountain Standard Time. It's Arizona time. It's confusing right now because of daylight savings, but we're the same as Pacific time. So keep an eye out for our emails and our social media posts about the next webinar, and appreciate you all for coming out.
And thanks so much for having me and providing education. It's so important.
Thanks a lot,
Thanks,
Trevor. We
Trevor.
appreciate it.
Thank
Awesome.
you, Trevor.
Thank you, Trevor.
Nice to meet everybody.
Get well soon, buddy.
Take care. Thank you.
Okay.
Thanks, guys. Have a good night.
Thanks, Trevor. Appreciate it.
Take care. All right. Bye-bye.